Strip away every indicator and one thing still tells you who's in control. Market structure, the simple sequence of highs and lows. It's the foundation under everything else in the Confluence method, because it answers the first question of any trade. Is this an uptrend, a downtrend, or neither? Today we'll read structure properly, spot the break that signals a shift, and catch the subtle warning that comes before it. An uptrend is nothing more than a series of higher highs and higher lows. Each push-up exceeds the last peak, and each pullback bottoms above the prior low. As long as that sequence holds, buyers are in control and you only look for longs. A downtrend is the mirror, lower highs and lower lows. This sounds basic, but most traders skip it and jump straight to indicators on a chart whose trend they never actually defined. Read the highs and lows first and you're already ahead. Here's the principle that keeps you out of trouble. Structure is the trend itself. It's not a lagging signal, it's the ground truth. An oscillator can say oversold, a moving average can curl up, but if price is still making lower highs and lower lows, the trend is down. When an indicator disagrees with structure, structure wins. Always trade in the direction the highs and lows are pointing. Now the shift. In that uptrend, the line in the sand is the most recent higher low. As long as it holds, the trend is intact. But when price closes below that last higher low, it has broken structure, a break of structure or BOS. That's the first objective evidence that control has changed hands. The chain of higher lows is broken, and the path of least resistance may have flipped. The BOS is your structural trigger to stop looking for longs and start respecting the downside. But don't overreact to every dip. A common trap is calling a reversal on a single sharp pullback that merely undercuts a minor low. A true break of structure breaks a significant swing low on a closing basis, ideally with momentum behind it. What traders call a change of character, where the move down is suddenly larger and more aggressive than the pullbacks that came before. A shallow undercut on weak volume is often just a deeper pullback. Demand a decisive close and a change in behavior, not a one-candle poke. On a real chart, mark the swing highs and lows and the story writes itself. A staircase of higher lows you can buy pullbacks against, and a clear level, the last higher low, that defines where the trend would break. While structure is bullish, you buy dips. The moment price decisively breaks the last higher low, the easy long trade is over and you stand aside or flip your bias. Structure gives you both your direction and your exit. Place it in the method. Market structure is the price action signal, the first of the four, and the one that sets your directional bias for everything else. A key level tells you where, momentum tells you if there's force, and a trigger tells you when. But structure tells you which way you're even allowed to trade. Get the structure read right and the other three signals fall into place. So, higher highs and higher lows mean uptrend. The last higher low is your line in the sand. A decisive close below it is a break of structure, and a sudden change of character warns first. Trade with structure, exit on the break. Master this one skill and every other tool gets sharper. Subscribe for the full method and trade your own plan. Education, not financial advice.